Welcome back to Red Stocks, everyone. In this video, we're going to be looking at GameStop and specifically why Michael Burry was right in his big bet on GameStop. I'm going to give you 3 reasons why he was right, as well as a valuation and target price for the stock. Let's get right into it. Now we're going to go over a brief overview of GameStop, ticker symbol GME. GameStop is the biggest video game retailer in the world, specialty video game retailer that is. They sell video game products, memorabilia, and hardware, importantly, and they have locations around the United States most prominently. So their biggest items are, in fact, the hardware items, the PlayStations, the Xbox, and the Nintendo Switches. That's where they make a majority of their revenue as of right now. So that's a brief overview. Let's take a look at where Michael Burry holds this position in his portfolio. So currently, he owns it as 13% of his whole holdings, of his whole stock holdings. That is, this is different than his options portfolio. Go watch my video on his options portfolio if you want to see that. So GameStop is 13.14%, totaling over 11 million, almost $12 million of GameStop in that holding position. So let's take a look here at the market cap and enterprise value, as well as a recent 3-month chart of GameStop, so we can see a little bit of an overview of what's been going on. So we see here that the market cap is almost 900 million. This is probably going to be changing by the time you watch the video because, as you can see, the stock price has been fairly volatile, going up 20% in some cases in one day. And here we have the enterprise value, where it's about $1 billion, depending on when you take a look at this pick. That includes debt and market cap, as well as minority interest, which they don't have much of. So price to sales here, very low at 0.17. And then I thought I would include this here just to give you a little bit of an insight as to where they are financially. 0.63 cash to debt. So for every dollar of debt, they have 63 cents of cash on their balance sheet. So that's going to be important. Now we're going to get into a few reasons why GameStop's stock price has appreciated over 230% in the past 3 months, going from under $5 a share to over $13.30 a share and almost hitting 15. Who knows, when you're watching it, it could be up to 20. Who knows? So let's get right into it. The first major reason is the Microsoft relationship and Microsoft deal that GameStop just entered into. So Microsoft is going to be providing front-end and back-end solutions to GameStop in the form of Microsoft 365, so that's going to be in their stores as a software solution, and then also providing them with Surface tablets for their salespeople and associates to run the stores more efficiently. And then on top of that, some back-end software with cloud computing to help improve their inventorying and sales and techniques. So the other reason is, and the other part of this is the boost to Xbox product offerings with the new line of Xboxes and the former line of the legacy Xboxes. They're going to be having some key product offerings in hardware and accessories of these new Xboxes. So this is hopefully going to boost in-store sales for GameStop, as well as really maintain a good partnership between Microsoft and GameStop. So this could be a key coming up through the new console cycle of Microsoft and GameStop. So the other key point here, the main point in my opinion, that a lot of people are also catching on to, is that Microsoft will give GameStop a share of Xbox's digital revenue. These are just a couple of the headlines. This is pretty much the gist of it. And expect to see a 1 to 10% cut of digital revenues coming GameStop's way. So this is going to be a very big deal with the new consoles coming out now. And GameStop is actually going to be seeing a cut of the new game revenue. Now, you might think that this is a little bit far-fetched, like why would Microsoft ever do that? Microsoft knows what they're doing. They're an advanced company, one of the biggest companies. They know that if they can partner with GameStop, they're going to be able to get ahead in the console battle between them and the PlayStation and hopefully come out on top. Because last time with the Xbox One, they didn't do so well. So now, hopefully, the Microsoft Xbox console is going to do even better because of their partnership with GameStop. And this is going to give a massive boost to GameStop's bottom line revenue, because if we look at this, this is basically like a royalty. There are going to be no expenses associated with this line of revenue. That's really important to notice. Anytime you can get a revenue stream that has very high margins, that's a really good thing for a business. And we see that right now with GameStop introducing a new line of digital revenues. Next, we have the continuing short squeeze of the GameStop stock. So we're going to do a quick overview of what selling short is and just the overview of that process, and it is going to give us an insight into the coming short squeeze in GameStop. So here we have the first step is you borrow the short seller borrows the stock from the broker. Next, the short seller sells the stock on the market. And then number 3, when they're going to close their short position, they repurchase the stock from the market, and then they return the stock to the broker that they initially borrowed. Now, this is important because right now, most of the stock in GameStop is actually held short, and it's being sold to the market, and it hasn't been purchased back yet. And this is going to be important to notice in this example. This is not GameStop. This is a generic stock that I chose that experienced a short squeeze. We see here that when stocks have a high short interest, they go down, they go down, they go down until a certain point where there's the short squeeze. And the short squeeze is when essentially the shorts have to cover their short position. Like we saw, they have to buy back their shares from the market so then they can give them back to the broker. So we see here they buy back the shares. That's bidding the stock price up. It goes up, 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 up. And then it just continues to go up. It can go up like many times in some cases. And we've seen that in GameStop with the stock has gone up over 200% in the past 3 months. So this is a continuing short squeeze. And we're going to see why here the short squeeze is poised to continue. So this is from October 13th. This is data from that point. We see the short interest in GameStop actually exceeds the shares outstanding. So the way that happens is that we saw in that diagram here, we're going to go back, that the short seller borrows the stock from the broker, and then they sell the stock to the market. Well, what happens is the market can then give the stock back to the broker, who then can sell it who then can lend it to the short seller again. So the same stock might be sold short by 2 different people. That's a simple oversimplified way to think about it. That's not exactly how it works, but that's pretty much how it works. So we see here that the short interest in GameStop is much higher than even the shares outstanding. This makes GameStop the most shorted stock on the entire stock exchange, on either of the American stock exchanges. That's very, very crazy. The best performing stocks since the start of the coronavirus crisis, or not the best, but a cohort of them, has actually been the most shorted stocks. So the most shorted stocks have actually outperformed, and that's the past few weeks and months. So moving on, we have the GameStop chart. We see this is the short squeeze that we were talking about. So here we have the high short interest down at the bottom, trading at around $4, and then the short squeeze happens. A little bit of good news. The investors start becoming a little bit more bullish, and a positive earnings report comes out, and the stock skyrockets. So that's what we're seeing now. But we still have a long way to go in terms of the short squeeze. Many short sellers need to still cover their shorts. So the price of $13, it could very well go up because the short sellers have a very short time to cover because of margin calls and other requirements. So the last major catalyst is from a massive ownership stake from this guy, Ryan Cohen. So he's the founder of Chewy. This is actually a pet service, a retail pet service that is an online retailer that sends pet items to direct to consumers from online. So he just took a massive stake in GameStop, a 10% ownership he just took. And this is the quote that he made on GameStop right after his ownership stake was announced. Rather than just offering video games and a smattering of toys, clothing, and accessories, GameStop's website would sell a wide range of merchandise and ship it to customers more quickly. So the way he wants to do that is by leveraging GameStop's existing retail base, so their existing stores, to essentially use them as mini warehouses in some cases. So hold merchandise there, and then more efficiently than even Amazon, send that out to customers. And he's also on the record as saying that he wants GameStop to actually beat Amazon in terms of shipping time, which is very impressive because if you know Amazon with Amazon Prime, they have 2-day shipping. That's very quick. He wants to beat that for GameStop in the video game space. And I think that's possible. And if there's one guy in the world that knows about specialty retail, it's this guy. And he just took a 10% ownership stake, and he's going to be very involved in the running of the company, not to mention a whole host of other great well-known investors like Michael Burry and a number of others who have massive stakes in the company. I think it adds up to something like 33% at this point. So that's going to be important to note that with these super investors and specialty investors, there's going to be a great incentive for the management team to apply themselves and work quickly. So here's a comparison between the capital expenditures of GameStop and Chewy, the company he founded, just showing you that they're pretty similar businesses that require about the same capital expenditures to maintain, and that he knows something about each of them probably because they are similar business models. So that's interesting. Now for the last section with the target price and what I think is going to happen, we're going to look at 3 different scenarios. Well, really 4. We're going to look at the current value, a base case, a bull case, and a bear case. And I'm going to have a little bit of data to back up each of those different cases. So I'm doing this valuation based off of price to sales. Yes, that's a little bit basic, but I think it works for this case because of a few reasons. And I don't want to give you the impression that this is going to be a full discounted cash flow. This is just a basic valuation. So on the base case, we're looking at a price to sales of 0.5. And that's going to give us a price per share of around $43 per share if the current amount of shares outstanding continues into perpetuity. And then the bull case is going to be a price to sales of 0.7 with a price of $60 per share. And then the bear case is going to be a price to sales of 0.1 with $8 per share. And this all seems very interesting considering the current price of around $13 a share. How am I getting these different numbers? Why am I choosing 0.5 price to sales, 0.7 price to sales? Here's the main reason why. I have this source here, which is the GameStop price to sales ratio over time. We can see it's gone up as far as 1.5 times sales, all the way crashing down through the financial crisis to under 0.5, but it's hovered really around that 0.5 mark, gone up to 0.7 there, and it's really just been in a big decline since 2008. So we can see that there's been a long time around the 0.5, it's hit the 0.7, but really it's in the big decline. So that's why I have the base case at around 0.5, the bull case at around 0.7, and the bear case at 0.1, where it's been really low recently at that 0.1 level. So these are the 3 cases that I see, and I went and did some more research, and I found that the average price to sales for retail special lines, which is the industry that GameStop is in, is actually a 0.71. So I used that as the marker for my high bull case. I decided I would make it that number as well because that is the average, and I'll just decide to keep a margin of safety there. So conservatively, I think into the long run, 5-10 years from now, GameStop could be trading at $60 per share if they execute the plans of Ryan Cohen, the founder of Chewy, that he has for the online retailing, and the partnership with Microsoft. If that goes well, it could very well trade up to $60 per share. Whereas the bear case, it really isn't going to go down much. So let's say you hold GameStop for 5 years and it just sort of goes nowhere. That's not going to really be that big of a loss compared to the potential gain you could have had if you held on to GameStop. That's a massive gain from $13.30 to $60, even from current prices. So that's why I think that you might be well off to hold GameStop for now if you are a current holder, and do some more research if you aren't a holder right now, but you're thinking about it. I would do some research into what you think the odds are that they're going to be able to follow through with their turnaround. So thank you for watching. Be sure to subscribe if you want to see more, and like and comment and tell me what you think. Thanks for watching.